Assalamu alaikum dear students. Today our topic is returns. As we discussed the risk already and you studied risk, but I'm just only memorize the risk. That risk is what? Risk is the difference between the actual and expected expectations. So the difference between the actual result and the expectations, that is called risk. Or simply we can define the risk that chances of losses, that is called the risk. For the risk calculation we are using the CAPM model. We also have different types of the risk then, like systematic and non-systematic risk. So now I'm not going in the detailed explanation because already we discussed these in the fifth semester and you already solved some practical question on it as well as. So we will straightforward move to our topic, and our topic center today is returns. Returns in our in investment point of view, a return is the income received on investment plus any change in the price, usually expressed as a percent of the beginning market price of investment. Look it in the definition. The returns say the definition of the return says that return is the income received on investment and price change in the market. Income received here means interest or dividends. Definitely when investor make investment, so investor will receive investment interest or dividends. Interest will be received on the debts instruments like bonds, and dividends will be received on the equity investment. Dividends, we can define the dividend as like profit on share investment, that is dividend. So look it, that is the income which is received from the investment. Change in market price is also a sort of returns. If the market price of a bond is $100, you buy it on $100. After some period of time, the price of bond, market price of bond is increased to $110 and you sold out that one. Means your purchasing price was 100, now you sold out it on 110. So $10 on high price you sold out it. This $10 is called capital gain. This is also one sort of what? Returns. Maybe there is a possibility that your purchasing price was 100, now the market price is going downward to 80 and you are fearing that further the price will be decrease, so you sold out it on $80. Now the difference between selling and purchasing price, that is called what? Capital loss. So dear students, in this you can see the two portion here. One is your total returns is equals to CFT, cash flow at time t. Your return, your income received at time t. CFT means cash flow at time t, plus PE, price ending, minus PB, price beginning, divided by PB. Now this portion PE minus PB divided by PB, this is what? This is change in price. So either this will be capital gain, this portion, or this will be capital loss. And what will be the result? So we will add those result with our CFT, and CFT will be your dividends, or that will be your interest. So returns now, the formula of the total returns, that consists of two parts. Number one, CFT plus PE minus PB divided by PB. So CFT is your dividends or interest, and PE minus PB divided by PB, that is your capital gain or capital loss. Capital gain means when selling price is more than buying price, so the difference is capital gain. And when selling price is less than the buying price, so in that situation, that is called capital loss. But here look at returns. So some question arises here. Some of the students, they are considering returns and profit in same category. They say that profit is same and as returns, but this there is a little bit difference. If I invest $100 and on that $100 I get $5, like I make some extra surplus, I received $5. So this $5 is my profit. Like look at, I buy a mobile on $100 and I sold out it on $105. So this $5 is my profit. This will not be called my returns. When this will be called returns? When I divide this 5 by 100. Look at how. Just a minute. Look at sales price, your cost price of mobile. Yeah, simply I say that purchase price. So I purchase this mobile on $100. When I purchase it on $100, so after some days I sold out it on 100 and let's suppose $20. So now this $20 is my what? That is my profit or gross profit. Profit is how much? Now $20. This is called what? This is called profit. This 20 is called my profit. This is not called returns. When this will be called returns. So return, this will be called return when look it, when this 20 I divided on the cost price or purchasing price. So 20 0.20, or this is equals to 20%. This 20% is called my returns. So the difference between profit and return is that returns will be in the percentage form. Clear now? Now here total return is you know that total return, return is consist of the income received from the investment plus fluctuation in the market price or fluctuation in the buying and selling price. So this is called the returns. It means that returns have consist of two components. One is called yield and second one is called capital gain or loss. This cash flow A time T, this is called yield. Clear? Or this is called income received. So yield is what the basic components many investors think of when discussing investing returns. The periodic cash flow of or income on the investment, either interest or dividends. So the distinguishing features of these payment is that the issuer make the payments in cash to the holders of the assets. Like look at, you are a bond holders, so you are receiving fixed interest annually basis, on annually basis or semi-annually basis, you are receiving the fixed returns. So that fixed interest, that is called what? That is called yield. Clear? And sometimes when the market price is increasing or decreasing, so you sold out that bonds, that shares or those security in the market. So if price is higher and your purchasing price is less, so you are getting capital gain. And if your selling price is less, then your buying price. So in these two situations, that yield will be called capital loss. So capital gain or loss is the second component, is the appreciation or depreciation in the price of the assets. Clear? Increase, appreciation, decrease, depreciation, commonly called the capital gain or capital loss. So your total returns we can express as yield CFT plus price change, change in price. So change in price may be positive or may be negative. Achha. Now this is a simple example of their returns. The stock price for the stock company A was $10 per shares in our beginning price, PB, that is $10. 1 year ago, the stock is currently trading at $9.50 per share. Now the current market price is 9.50. It means that, look it, compare 10 with 9.50. 1 year before the stock price was $10. Now the current market price is 9.50. It means that 0.50 the stock price is decrease. Clear? And shareholder just received $1 dividends. After 1 year, the shareholders or the owners of this stock received $1 dividends. So what returns was earned over the past years. What is the total returns received by what by the shareholders. So normally we say that we received one dividend, so that is our returns. No, look it, we received the dividend one, but if we looked out, so 1 year back we purchased this on $10. Now the price of the stock is decreased to 9.50. If I sold out this in the market, so I will not sold out it on 10, yeah, not more than 10, I will sold out it on 9.50. So locate what is PE, that is our current market price, clear, 9.50 minus PB, beginning price. So beginning price was 10. Yeah, we can say that new price minus old price divided by old price. PE, that is new price, and PB is old price. Yeah, clear? So 9.50 minus 10 divided by 10. So when we make these calculations, that is equals to 5%. Instead of 10% returns, this is our 5%. Why? If the current market price was also $10, so then our returns will be 10%, but due to decrease 9 up to 9.50, so our return is 5%. Now I will solve an question on it to calculate the proper returns. Look it, this is the questions year 2000, 2001, 2002, 2003 up to 2008, and this is the index value of the stock. Index value means the ending price of the stock, that is called what? Index value. When 2000 was end, so at the end of the 2000, the price per security price was $48.5. In the end of 2001, the price was 55.30, and similarly so on. Now look at here, we will I will remove this one. Look at, now I will check that how much change in the price taken place as compared to 2001 and 2 when we compare. So either the price of the stock is increase or decrease, in appreciation taken place or depreciation taken place. If appreciation taken place, so how much appreciation taken place? If depreciation taken place, depreciation means decrease in price. Like look at in 2000, the year 2000 closing, like in 2002 and 3, so depreciation taken place. Why? Prices of this stock is decreasing from $61.20 to $29.60. Clear? So index value, yeah, IV, that is our words, that is the ending price of the stock at some specific period of time. Acha, now we will finding out the returns. Returns means that when we purchase the stock in 2000 and closing value was 48.50. Now in 2001, at the end of the 2001, the market price of the stock is increased to 55.30. So we calculate that how much returns we earn, how much returns we get. Now for the 2001, 2000 is our PB, that is our beginning price. 2001 price is our ending price. Clear? So now PE, current, 2001 is our current and 2000 is our previous. So current price minus previous price. Clear? For 2002, 2001 is our what? That is our beginning. And similarly for 2003, 2002 price is beginning, and so on. Now we will calculate the returns for 2001, because for 2000 we can't calculate. Why? Because we don't have the 1999 data here. For the before the 2000 year we don't have the data, so we will make calculation from the 2001. Now 2001 PE is 55 ending price minus PB beginning is 2000 price. So now here if you looked out, that is what? 6.80 positive returns. It means that 6.80 appreciation taken place in the price. Second one, again look it, for 2002 we are calculating the return. So for 2002, 2001 is beginning and 2002 is our ending. So PE is 2002 price and PB is now the 2001 price, and in this way I will calculate one by one. Now look it, for 2003 we are calculating the returns. So 2003 is our ending price, and now for 2003, 2002 is our beginning price. Here look it, the answer is in negative, 11.60 negative bracket. Why? Look it, closing price of 2002 of the stock was $61.20, and now for the 2003 the closing price is 49.60. نو مطلب دلته کې څه شو؟ ګوره پرایس کم شوی دی د 61.20 نه reduce شوی price is reduced to 49.60. How much? 11.60. So this is capital loss, and the for 2001 and 2002 6.80, 5.90, that is what? Capital gain. Now dear students, for 2004 current minus previous year, so 5.50 positive capital gain. For 2005 current minus 2004 price, index price is basic, so 5.70 positive again capital gain. Acha, for 2006 price minus the 2005 price, and so on. Yes, you can like look at, we drag the formula for the remaining two items. Here in 2007 return is negative 11.70. Why? Look at, price decreased from 75.50 to 63.80. So depreciation. Now we calculate the returns. Now according to the formula which is given, CF, look at, or total returns total return TR is equals to CFT plus PE minus PB divided by PB. This was the formula. Now look at CFT, that is dividend. This is called CFT. Clear? We calculate the returns here PE minus PB. We find out this one. Now we need CFT. CFT means the income stream in shape of interest or dividend. So as this is a stock, equity stock, so dividends. Now the dividend which is declared by and given by the corporation. So on 2002, let's suppose $2 dividend per stock is declared. Then in 2001, 2.7 per. In 2002, $3.15 per stock dividend, and so on, 3.60, 3.90, 4.10, 4.16, 5.5, 6.6. These are the dividends. Now we need to calculate the total returns. This is single returns. Now we are going to calculate the total returns on the appreciation and depreciation plus the dividends. Clear? So now for the total returns for 2000 we can't calculate because we don't have the previous year data. So we will start from here, 2001. So in 2001 our total return is, we should through by formula. Now I put the formulas, but look it again, I will put the formula is equals to sign. Look at here, I write PB plus C divided by PB. What does it mean? Look at it means this is my column A, this is my column B, this is column C, now column D. So column D is equals to B plus C. What we will do? B plus C. B column is my returns. Clear? PE minus PB. So already look at in this formula, PE minus PB. What is the result? That is this one, B, plus CFT. CFT is my dividend column. C column here, look at C column, dividend, and dividend means CFT, cash flow at time T. So plus this dividend. Clear? And divide by PB. PB means for 2001 PB old year is what? 2000. 1 for 2001, 2000 is our previous year. So the price of the previous year, this one, and I enter it. So when I enter it, that is how much? 6.86. 6.86. Clear now? Acha. This is our words. Now we are calculating the total returns. Okay, I have some problem here in the data. Look at now is equals to, so return is from the formula. Now look at PE minus PB. We calculate already PE minus PB. So PE minus PB, this one, plus CFT, and CFT is means dividend or interest. So this is my CFT column, divided by PB. So for 2001, 2000 is my index value 48.50 and enter. That is 0.20. Clear? Now for the 2002 we are calculating, so is equals to for 2002 PE minus PB in returns column plus dividend divide by old year price, and for 2002 2001 index value price divide by, so 0.16. Now I will dragging down it to this one. Now look, it is equals to, this is my for 2003 is plus dividend divide by 2001. Look at here, total return is negative 0.13, and one by one we will calculate like this. Now dear students, we calculate the total returns PE minus PB plus CFT divided by PB. Clear? Now if you looked out here in the total return, so our two value, that is negative. Which one value? Like this one, this value and this value, that is negative. So to remove this negative, what we do, we need to convert it to positive. Clear? And for that we have returns relative concept, and the return relative concept we will discuss in my upcoming class, because our class is now going to be lengthy, so you will be get bored. Up to this, that how we can calculate the total returns on the per years of the stock. So we calculate here the total returns, that if a stock in 2000 when we purchase on $48.5, so actually their price appreciation plus dividend receiving, so that is 20%. Look at, we can also convert these total returns columns to percentage form. How we can convert it to percentage form? Now look at how this returns I'm showing. Now look at in 2001 20% we got the returns in a price appreciation, capital gain plus dividend. So that is when we calculated 20% is our total returns. In 2002 or 16% total returns. Clear? In 2003 our return is negative 13%. In depreciation taken place, why? Due to decrease in the, even though we received the dividend here 3.60, but capital loss is too much high, $11.60, means that our buying price old year price was 61.20, but current market price is too much less, depreciation taken place in the price. That's why our total return percentage is in the negative. In the 2004 our return is 19%. Clear? And in and so on further. So here we have negative 13% and negative 8% here total returns. So we need to convert it to positive. For that purpose we are using the return relative concept, and inshallah from this point we will start our class to calculate the return relative and then the cumulative wealth index concept as well as. So Till then, Allah Hafiz, see you inshallah.